The Japanese yen has been at the epicentre of the so-called currency wars, as the country's central bank seems to be making deliberate attempts to get its economy back on track, giving rise to criticism from its neighbours over their apparent currency manipulation. However, in contrast, according to the IMF, concerns over a depreciating yen are overstated and the Bank of Japan should act more. With this in mind, I'm joined down the line by Peter Kinsella for a yen-themed Targets in Focus. Now, Peter, first of all, the trading week may be coming to a close, but we have a politically packed weekend ahead of us with the Italian elections looming and the sequester talks taking place in the US. How heavily will these events play in investors' minds, do you think, and how would you describe market sentiment at present?
Well, I think market sentiment is basically taking a little bit of a correction. This was kind of long overdue, and it's probably a good thing that has happened. What you've seen over the course of the week is that obviously precious metals have taken a bit of a beating, gold, silver, and amongst others. And you've also seen equities have taken a little bit of pain. And realistically speaking, you've got to realise that since pretty much September or August of last year, we've more or less been in a constant rally in terms of equity space. As a result, having some sort of a correction is pretty much overdue and is rather healthy. Now, there's two things really that are quite interesting. On the fundamental side, what you've seen is that the Federal Reserve have indicated in their minutes this week that they are considering taking a less aggressive stance towards their QE policy. So by that, what I mean, that could mean either they stop their QE policy sooner than the market had originally assumed, or that they do less Treasury purchases and MBS purchases. So this is quite good for the dollar. At the same time, what you've seen today with the LTRO data from the ECB is that the data was less than expected. The market was expecting about 130 billion in terms of repayments, and instead what we got today was about 61. So this implies, first of all, that the expected sort of ECB balance sheet contraction was not as severe as we would have originally thought. More to the point, we're pretty much coming to the end now of talking about ECB balance sheet contraction, at least for another 6 months to 1 year. So really what that's done is that's put the dollar at a fairly strong bid, and obviously the euro's taken a bath with that. So what you've seen over the course of the week really is precious metals coming lower, you've seen the euro coming under pressure, and obviously equities coming under pressure.
The US dollar was spotted slightly higher against the Japanese yen in Friday's session, ahead of Prime Minister Shinzo Abe's meeting with President Barack Obama later on today. The meeting is designed to bolster relations between the two countries, but what are your predictions for their currencies over the next few months?
I think this is two things really. Following the G20 meeting last weekend, what you've noticed that the statement was, let's say, was interesting, not so much for what it said, but for what it didn't say. There was no specific or explicit censure of Japanese monetary policy mix. So that's pretty much given a green light to the Japanese authorities to continue with their very much sort of expansionary policy mix, which includes asset purchases and then by corollary means a weaker yen. So we can expect that sort of this theme of broad yen weakness is going to continue, and it's not going to stop soon. In terms of where we're going to go, I mean, it's probably not unreasonable to suggest that we're going towards 95 to 100 in dollar yen, probably within the next 6 months.
The British pound has taken a bit of a battering this week, plunging against most of its counterparts. But what are your predictions for it in the short, mid and longer term? And what will be the main factors driving it forward, Peter?
Well, there's two things. The first thing is to say, okay, well, why was sterling strong in the first place? And really what you saw over the course of last year was that the pound was strong for two reasons. The first reason being sort of a large increase in UK real yields. In fact, the UK posted, let's say, the most impressive outperformance in terms of real yields amongst all of the G3 currencies. So what we've seen now this year is that inflation expectations are slightly higher, and gilt yields are a little bit higher, but really what it's telling us is that sort of real yield improvement that we had last year is not going to take place this year. So that's obviously a burden for the pound. On the other hand, what you've seen is that one of the reasons for sterling strength last year was significant gilt purchases by overseas investors who were fleeing sort of the Eurozone. And now that the Eurozone situation is somewhat, let's say, contained or under control, the extent and the level of those gilt purchases from foreigners will certainly be diminished. As a result, then, those two sort of, let's say, cyclical type of factors are certainly not supporting the pound to the same extent that they were. This year, what you've also got now is that you've got a threat of a possible UK ratings downgrade to the AAA status, and that's obviously going to be a burden for the pound. But in addition to that, the proposed, let's say, nominal GDP target that's being talked about by the incoming Governor Carney, amongst others, that will basically end up creating much more inflation within the UK. So you've got a situation where you've got a very low growth economy. Max we're going to see is 1% economic growth this year, with moderately high inflation in and around 3%. That's never really a good combination for a currency, and it won't be for the pound this year either. So as a result, the pound has taken a little bit of a battering this week, in particular against the dollar. Against the yen, we're probably more likely to see slightly higher levels in sterling yen, but that's really just a reflection of the incredibly weak yen that we expect to see over the coming sort of months.
Looking at the euro yen, the pair is suffering from the opposite forces of the single currency and the Japanese yen, as the European currency remains under heavy pressure after yesterday's FOMC meeting minutes, whilst the latter is well bid in today's context of increased risk aversion. Are you bullish or bearish for this pair?
The problem with this, with both of these currencies, is that you're dealing with two currencies that are both going to weaken for various fundamental reasons and for good reasons. Obviously, in the case of the eurozone, I explained earlier on, they're not going to benefit from ECB balance sheet contraction to the same extent that they have over the last 3 or 4 months. On the other hand, what you've got is a very, very sort of vigorous monetary easing policy on the part of the Japanese. So really, what you're seeing is it's kind of a real old school ugly contest between both currencies. In general, what we're more likely to see is a slight outperformance of the euro, very, very slight. But once again, this is most likely simply due to the excessive weakness that we're rather likely to see on the part of the Japanese.
Peter, thank you for your predictions. Well, that's all for now, but for a recap of all the main data releases and financial news stories, take a look at our weekly wrap-up interview. Bye for now.